Welcome to TheoTrade. This is Don Kaufman. Here we are. It is February 8th, 2017, doing the Theo Night video. First and foremost, the S&Ps today trade in what I would term a relatively tight trading range. Now, this includes, of course, overnight trade, but you can see during the trading session here, we traded down to 2281 as high as, well, roughly where we're closed at right now, which is 2291. So what I would definitely term another kind of lackluster day. However, with saying that about the S&P futures, all right, a little lackluster. We didn't get much action. We sold off here a bit in the earlier hours. Again, I want to reiterate a bit of a strategy that I did in Monday's session, and that had to do with what we termed this buy and bail straddle. So let me reference the SPX, and if you missed Monday's session, don't worry, it's all archived out there. But on Monday, I was talking about this idea of a buy and bail straddle, where for the most part, if you look at what the markets are expecting, okay, but this is now, again, we're looking at Friday's expiration. This is really short-term stuff. You know, we're not talking about a week from now. I'll come to that in just a couple of moments. There are some other items in the market that, you know, are pretty distinctive today. But really, in reiterating this strategy, this buy and bail, because we got so many questions about it, the expected move between now and Friday is $12.50. Okay, that includes all day Thursday of trade and all day Friday of trade. Again, these options expire Friday afternoon. However, if you take a look in detail here, the SPX is closing right around 22, we'll call it 95. Look at the 22.95 calls plus the 22.95 puts. And the interesting thing is the at the money straddle for the next 2 days is only trading for $9.35. And let me just lock the price down right now. You have to ask yourself, you think we can move more than $9.40, right? Go look at the chart from today. Well, today we actually traded roughly what? Inside of a $10 range. But now, what's interesting here is you're giving 2 days to try to get your $10 back. Now, what you try to do with this buy and bail straddle is, for the most part, you buy the straddle, okay? If the market moves one direction to the other, you can sell out of the straddle, try to get your $9.40 back, and you get a free ride on the other side of it. So, for example, let's say the market tomorrow, which is Thursday, rallied, and the market rallied as much as 10 points. You would try to sell out of the 22.95 calls for around $10. Then you're left with the 22.95 puts on a free ride. This is actually similar and an entrance, okay, to an old school strategy called gamma scalping. And I'm simplifying it here, and it's termed, again, kind of a buy and bail straddle. Now, that was a reference, of course, to what we did a little bit on Monday, which has actually played out relatively nicely in the last 2 days of trade. Close that up. So what else is really going on in the markets? Well, for the most part, the real standout over here, it's not so much the lack of movement in the S&Ps. There's two things that stand out really in my mind. Bonds, they're rocking right now. Bonds did 320,000 contracts. The ZN over here, which is the 10-year, that's 10-year notes, does 1.6 million contracts. Now, for those of you that don't look at bonds at all right, or notes, okay, is that a lot? And the answer is, yeah, you know, some of the activity is actually picking up in just the last couple of trading sessions as the bonds and notes are rallying over here. But this is not necessarily, you know, what's just catching my attention over here. You have to ask yourself, oh, okay, the bonds are going higher. What does it really mean? Why are traders all of a sudden diving into bonds? All you're hearing about, the economy is getting better right now. And if the bonds are going higher, that's actually taking the interest rates lower. Go look at the interest rate. That's the TNX. What does it stand for? The 10-year Treasury Index. That's a pretty slippery slope. It's back down to about 2.35%. I know it says 23.5, but it's actually quoted as, this is the 10-year. Again, the 10-year, which all your mortgages are based off of, we're back down to about, again, 2.35%. Okay, where does this leave us? As the interest rates come back down, you got to cruise over to the financials. Now, the financials are still trapped in this, again, infinitely tighter and tighter range. It's actually becoming comical. You can see, again, the financials are trapped in an incredibly tight range, coiled up right at about that 2350 mark. Although the financials are slipping in the last two trading sessions, you have to ask yourself, wouldn't you expect more financial slippage, if you will, that is the financial selling off, with the fact that the bonds, okay, they've been on the tear to the upside. The next day or two, between Thursday, Friday, these bonds start to break out. And again, we'll zoom out for just a moment. It's also important, anytime you're looking at a futures contract, go over here, contract adjust, hit apply, hit OK. The bonds have the opportunity in the next day or two. These things could break out to the upside. And for those of you, if you tune in on a day-to-day basis, I've been talking exactly about this, okay? I am long these bonds. Now, listen, I'm not trading them into them huge over here. I'm Captain One Lot, right? Captain One Lot rides again. I got a one lot of the ZB, and I've been in it. Nice, trade, yada, yada, yada. Listen, I am the contrarian in the bond product. I don't think the bonds, we're not going to go through bond Armageddon yet. I don't think anybody in the financial world, okay, or in the economic world wants interest rates to take off to the upside. They need to keep the interest rates relatively low. Even the new administration, come on, if interest rates take off north of like 3% in the 10-year, gone. Economy, okay, come to a crashing halt. These bonds, okay, may already be ahead of that. And we're at a pretty pivotal place over here. And specifically, if you want an exact level in here, all right, we're pretty close to it, but you start getting above 154, call it 154, and we break above 154 in the bond product specifically, you got yourself some legs possibly to the upside, and we may be riding up here to the 157, even 158 range in the bonds. If that occurs, at this point, you just got to ask yourself, what are these financials clawing to? What's holding them up at this point? Okay, nothing more than hopium in the market. I've also been watching under option statistics, okay, nothing huge going on inside of the XLF, but I did catch something else that's quite huge today, and that is activity inside of the VIX. I don't know why, don't have reasons just yet, but the option activity in the VIX today was quite large. It was rather large, almost 1 million contracts trade inside the VIX, which for the most part, it's about 1.7 times, okay, the 5-day average volume inside of the VIX, meaning that 885,000 contracts, about 5 times, okay, or if you look back over the last 5 trading days, it's about 1.7 times the norm versus, again, the previous 5 trading days. Now, along with the VIX seeing some large size go through it, the VVIX all of a sudden got lit earlier today. The VVIX is the volatility, okay, of the volatility index itself. And then the VVIX even threatened the 100 level. Again, when the VVIX gets lit to the upside over here, it doesn't mean that the sky is falling. I want to make that clear. It doesn't mean like, oh, here we go, we're coming down. It doesn't mean the sky is falling. But it sure does catch our attention, and I'll tell you why. Every time the VVIX gets lit up, it means someone's coming in there and they're net buyers of volatility. Any way you want to put it, they're buying volatility in the VIX product itself. Now, again, every time the VIX gets up to this 100 mark, it doesn't mean that the S&Ps are going to come down. Okay. However, it definitely puts us on our guard because above 100, okay, starts to become dramatically more risk. Now, looking at the VVIX autonomously, that doesn't do it for me. When I say it doesn't do it for me, like, okay, I'm not just going to look at the VVIX and, yeah, yada, 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 the sky is falling. Not at all. The VVIX got to get above 100, okay? Pretty close to it. Again, this is a product, it can move. On top of it, we've actually had quite a number of dramatically high skew readings. For those of you that never read skew, it's the out-of-the-money puts versus the out-of-the-money calls, okay, in the SPX. And we have had fairly high skew readings, although those come off a little bit. But really looking at a confluence of different items, the VVIX has increased, skew has been elevated, not massively, but that in combination with the bonds, okay, the bonds really have me looking now more than anything. Why are traders coming in and buying bonds? And that's what you should be able to, you got to be able to answer these questions over here. Bonds are usually used, okay, as a risk mitigation tactic. Now, we did see bonds back up in this neighborhood not too long ago, and the market didn't do much of anything over here. In the next day or two, though, we have the ability for the bonds to break out. If the bonds do break out, okay, I think the inevitable sell-side activity comes into the XLF, and finally does start to break the S&Ps down. Look for it here Thursday or Friday this week. Thanks everybody for joining us here at TheoTrade. Have a great evening. Bye-bye.